In previous session, we have been introduced with some anomalies where we concluded that when efficient market hypothesis uh, does not work, or there is there's a divergence in expectation of efficiency, market efficiency, and the reality in the market, uh, because it has become possible by some researchers that they have been able to identify the sources of return in the financial market, which may not be justified by the efficient market hypothesis. So we talked about you can recall most probably that post earnings announcement drift. Then we talked about excess volatility. Then we talked about January effect. Then we talked about Monday effect. And then this kind of anomalies have been identified that are in against of the support of efficient market hypothesis. But we also have seen evidence that there is evidence both in support of efficient market hypothesis and also support against the efficiency against the efficient market hypothesis. Okay, so the discrepancies that uh, are in contrary to the expectation of efficient market hypothesis are known as anomalies. That efficient market hypothesis say in when the a market has weak form of efficiency, we learned so far that it will not be possible for the technical analyst to make abnormal return. Uh, and when market is semi-strong form of efficiency, we have learned that is obviously the technical analysis will not work. Even the fundamental analysis will not work if the market has semi-strong form of market efficiency. And it is very unlikely to expect that market has a strong form of market efficiency. So in continuation with that, the anomalies so far have been discovered can be classified under three broad headings. One anomaly is fundamental, another is technical, and the final one is calendar anomalies. So commonly the fundamental and technical anomalies are observed, but the another classification, calendar anomalies, has been added. But the matter is that we have learned from the research of Pharma French research, and also from Jagadish research, that size factor, value factor, these are providing some return which is not justified by the CAPM model. So we have seen in previous class there some evidence that small stocks are generating higher return compared to large capitalization stock. And also we have seen evidence that high value stocks, the high value stocks uh, has provided superior performance relative to the low value stock. And this kind of anomalies, that size factor arising from size factor, arising from value factor, and also there are some anomalies like the stocks which have low PE ratio, which have low price to earnings ratio, have been observed that they provide higher return in future compared to the stocks which are currently trading at high PE ratio. And the low PE ratio are providing higher return relative to the stocks which have high PE ratio. So these are the examples of some fundamental anomalies which provide outperformance, and which also provide evidence that which are against the semi-strong form of market efficiency. That means if you are fundamental analyst, you make some fundamental assessment of the stock you are following and you are considering. And if you are uh, you are successful in achieving outperformance, in that case it is part of fundamental anomaly, because semi-strong for it is against the semi conclusion of semi-strong form of market efficiency. And the second one is technical anomalies, which are kind of, you probably have uh, learned about some technical analysis from your investment analysis, that it is possible to capitalize the technical investment strategies like following the support and resistance level, following the discrepancy in the long-term moving average and the short-term moving average, and also follow the long-term price trend, and uh, see the last couple of weeks price trend, and try to make the profit by analyzing this kind of trend. So there are several technical anomalies. Sorry, there are several technical analysis strategies, and it has been observed that technical analysts have been able to earn outperformance, have been able to show outperformance. So it has been proved that it is possible by analyzing the market data and to make profit out of that. So in that case, the anomalies, like if you apply the strategy of checking the discrepancy between long-term moving average and short-term moving average, and if you are able to generate profit from that, in that case, that is also that is the evidence of technical anomalies. And finally, the calendar anomalies. In previous class, I gave an highlight that it has been observed that the Monday, which is the opening date of the global stock market, not our market, global stock market opens on every Friday and is closed on every Friday. Begins on opens on every Monday and closed on every Friday. So it has been observed that every Monday the return is poor. The return is not higher compared to other days. Rather, it in Monday, in general, stocks underperform. And we talked about the Black Monday, which happens in 90s decade. And it has also been observed that what we mentioned in previous class, that in January, uh, on an average, the stocks outperform compared to other months. And it is also observed that there is a discrepancy between the return achieved in the first 4 days of any month, first 4 days and the last day of the month, compared to the month between these days. So these anomalies, what I just have mentioned, are related to some a specific date or a specific month, like uh, which can be traced by using a calendar, that this date uh, on this date it is expected that the stock will outperform, or on this date it is expected that the stock will underperform. So these anomalies are related to some specific date, a specific month. So these anomalies are broadly known as that these anomalies are calendar anomalies. But the thing is that you need to understand that we are very likely to use the capital asset pricing model to evaluate a stock. So when we see that the price you have measured by using the capital asset pricing model, and the price at which the stock is trading at the market price uh, differs for a long time. This differ for a long time, and we do not get the valid reason for this discrepancy. sometimes we try to identify that, and it is continuing, that there has been divergence between this price and the market price, and it has been continuing for several months, for couple of years. In that case, we try to identify that it is the evidence of some market anomalies, that because it is not expected that this divergence will continue for a long time if the efficient market hypothesis applies. But the thing is that we estimate the price based on which model. Commonly, we estimate the discount factor by using the capital asset pricing model, and we estimate the price based on that. Okay, so there has been a good debate between the people, between the academicians who are the believers of efficient market hypothesis and the person who does not believe the efficient market hypothesis. There is a good debate. Yeah, one school of thought believes in efficient market hypothesis, another school of thought does not believe in efficient market hypothesis. Okay, so can you recall who is the advocate of efficient market hypothesis? That means who is the pioneer in following the efficient market hypothesis? Who first coined this idea that market is efficient? Can you recall the people who are the advocate or who are the pioneer in advocating the efficient market hypothesis?
Marquich.
Hmm? But efficient market hypothesis is a kind of a very recent concept compared to the Marquis time. That means Marquis time, in the Marquis time, there was not that concept prevalent, but after that. Okay.
স্যার
Right.
ভুলে গেছে স্যার সে
Thanks.
নোবেল পাইছিল স্যার
Eugene Fama. Eugene Fama is the pioneer in advocating efficient market hypothesis, and the person, the leader of the persons or the leader of the academicians who do not believe or who always talk against the efficient market hypothesis, the leader in that school of thought is Thaler. Okay, have you heard about Thaler? Richard Thaler?
ইয়েস স্যার কয়েকদিন আগে স্যার 2018 এ মেবি নোবেল পাইছিল
So 2008 is few days back.
স্যার রিসেন্টলি
Okay, in terms of decade, it is recent decade. Okay, so that's good. Okay, so I think in your class also there are some people who like to support the Fama. Obviously also there are some people who like to support the Thaler. Okay, so the thing is that if you like to see that what is the debate or what are the areas of debate, that how Fama and Thaler differs, or how efficient market hypothesis believers and how efficient market hypothesis disbelievers argue against each other, you are requested to watch some YouTube videos where you will see that there has been open debate between Fama and Thaler. Both are professor of Chicago Booth School of Business. So both are from same school, but they respect each other's thought and they respect each other's belief. They respect each other's belief. Okay. So what I like to emphasize here, that when there's a discrepancy, say, let me give you an example, that fundamental anomalies, one example is size anomaly. Why? Because the large cap stock underperform and the small cap stock outperform. So according to the widely known asset pricing model, it is not it should not be that there should not be differences in the return of a small because of the size, because their size is different. it should not be the necessary reason to defer their returns. Rather, if small cap stocks have higher beta, which reflects the systematic risk, and if the large cap stocks has lower beta, only then, according to CAPM, we can justify why small cap stocks is outperforming the large cap stock. So, but pharma has showed that regardless of the beta differences and the differences in the return of a small cap stock and large cap stock cannot be explained by the beta which is available from the CAPM. So he has proposed some augmented model, augmented multi-factor model. He has added, or he has proposed some additional factors, size factor and value factor. Okay, so what is the thing? The thing is that the price of a small cap stock justified by the capital asset pricing model is not compatible with the price what is actually observed. So the people who advocate the behavioral finance, they advocate that this is arising because of the anomalies, this discrepancy, that the price justified by the CAPM and the price what is actually prevailing in the market, they are different because there is a presence of market anomalies. There is a presence of market anomalies. But just try to understand, pharma is a advocate of efficient market hypothesis. Would you expect that pharma will attribute this kind of discrepancy in the return for small cap stock and for the size factor? And if pharma is advocate of efficient market hypothesis, would pharma support that it is arising from some anomalies? The presence of anomalies disapprove the semi-strong form of market efficiency. When the semi-strong form of market efficiency does not work, then there is a scope for fundamental analysts to play and to have a gain. But if the anomalies is present, that means semi-strong form of market efficiency does not work. So it has been discovered that there is a return differences based on the size factor, based on their differences in size. So pharma is advocate of efficient market hypothesis. Do you think that pharma will support the findings that what he himself found that this discrepancy is because of anomalies? What do you think? If pharma proposes semi-strong form of market efficiency, so would pharma support the presence of anomalies in market?
No, sir.
So in that case, pharma is expected to give some alternative argument for this price discrepancy.
Yes, sir.
Okay, so pharma has told that it is not the anomaly which is causing the differences in price justified by the asset pricing model and price prevailing in the market. Rather, pharma has mentioned that the problem lies with the asset pricing model what we are using. The problem lies with what? The problem lies with the asset pricing model what we are using to estimate the justified price or to estimate the rational price. So when pharma has added the size factor, and pharma has also added the value factor, then pharma has been able to explain that the return, the discrepancy disappear. Now, when you use the pharma-French three-factor model, you would see that there is no differences in return justified by the Fama-French three factors model and the return prevailing in the market. So Fama has concluded that it is not the reason that there is a presence of anomaly in the market. That's why return is differing from the expected return. Rather, the difference in return is arising from a reason that we are using a asset pricing model which is incomplete. Which is incomplete for what? Which is incomplete to accommodate the factors which are responsible for providing return. It has not considered the differences in size factor. It has not considered the differences in value factor. And in 2015, Pharma has also proposed additional two factors in addition to the three factors, and which is known as Pharma Friends five factors model. So when you use the five factors model of Pharma Friends, you would see that there has been no alpha anymore. Can you recall the alpha? But it has been observed that when you use the CAPM, it has been observed, or it has been found by many academicians, that there has been significant alpha. So if asset pricing model is complete, there should not be any significant alpha. Have you got it? Can you recall this popular model? CAPM?
Yes, sir. Yes, sir.
Okay. So CAPM says that the return of a stock is directly proportional. The return of a stock is directly proportional to the beta it has. Return of the stock is directly proportional to the beta it has. Okay. If beta gets higher, the return should be higher. If beta gets lower, the return should be lower. So in that case, full explanation should be made by which one? Beta. If which one holds? CAPM holds. If CAPM does not hold, you would see that there has been a significant alpha. In that case, you need to find out the reason. You need to find out the reason, which factors are causing this alpha to be significant, which factors. So Pharma Friends has showed that when we consider size factor, when we consider the value factor, in addition to the beta, the systematic factor, we have been able to see that it has become insignificant. It has become insignificant. When it has become insignificant? When it is close to
0.
0. So there has been disagreement that what are the reason of anomalies. So if you are advocate of efficient market hypothesis, would you say that the anomaly is causing the anomaly or the fundamental anomaly or technical or calendar anomaly are causing these return differences, or the reason is that we are using some kind of incomplete model? If you are advocate of efficient market hypothesis,
It's an incomplete model.
okay, so you need to recognize that. But the thing is that it has also been observed that if I like to give an example from our market, if I want to ask you that which stocks are commonly known to you, can you tell me the name of three stocks? Three people will mention three stocks which are well known or which is very known to you. That if I ask you the name of several stocks from our market, it is very likely that you will mention those stocks in first or second chance.
So GP,
Then,
Square Pharma.
hmm,
So bet BC.
okay. Then if I ask you to mention the stock which have a very small cap, which has a very small capitalization, I mean their market price times the number of floating shares is in the very small quartile?
United Air,
United Air. Then
Sir, Dulamia Cotton.
then then
PHP Mutual,
sorry,
PHP Mutual Fund or Janata Mutual Fund. Cap
mutual
amount
fund.
কম.
Okay, right now I'm not asking about any mutual fund. I'm just asking about the stock. Okay.
So Talu spinning mill.
Okay. And now you see that can you expect that more information is available for this large cap stock compared to this small cap stock? More information is available.
Yes, sir.
Okay. More analysts are available for this. More participants are available for this stock.
Yes, sir.
Okay, compared to this small cap stock. In that case, what will be your conclusion? Your conclusion will be that the price of this large cap stock will be highly efficient, more efficient compared to this stock.
Yes, sir.
Okay, so that is the findings across the countries, across the market. Okay, and another thing, I like to highlight that. Okay, if I ask you to buy two stock in market, let's say two stocks are trading in the market, say, just assume that the Singer and another stock is Beko. Okay, some Beko products are available in Singer, just ignore that. I'm just thinking of Beko is another company. Okay, now which one you will buy first, or which one you are likely to buy between Singer and Beko, given that the fundamentals are very similar for both Singer and Beko?
Singer.
Okay, so why you are preferring Singer?
So because I know the company and the brand value I think is higher than Beko.
Okay, Singer is well known in our country. Beko is well known in the European country. Okay, but you are in favor of Singer because there is a ambiguity in the information of Beko to you, because you don't know very much about the Beko. You know very much about the Singer. So people have a ambiguity aversion bias. Instead of instead of having higher potential of Beko, Bangladeshi people will prefer to make investment in Singer. The reason is that people like to avoid the game where the ambiguity is higher. Where the ambiguity is higher. Okay. So just think of this. In US market, some Chinese stocks are also trading. In US market, some Chinese stocks are traded. Okay, so it has been observed that the Chinese stocks provide higher return compared to the US stocks. So the reason is that as there is inefficiency in the price of international stocks because of the information unavailability and the ambiguity, people like to underestimate the potential of international stock, underestimate, and people are likely to overestimate the local stock. Local stocks means which stocks? Local stocks means which stocks?
So investor যেই দেশের সেই দেশের কোম্পানিগুলো।
Right. Okay. So if you overestimate the local and underestimate the international, what is going to happen for the return in the future? This will provide higher return or this will provide higher return?
So international stocks will provide higher returns.
Why? Because as you are overestimating, all are overestimating this, it is likely that they will be end up paying higher price for it and they will be end up paying lower price for it. In that case, if the investors, the sophisticated investors capitalize on this, what will happen? Their return for international stocks will be higher. Okay. And it has also been observed in terms of market efficiency. You probably have heard about some alternative investment, which are derivative market and the cryptocurrency market and the venture capital market, and also the most popular one in our country is the real estate. Okay, so it is observed that in this alternative investment market, the market inefficiency is more prevalent. The market inefficiency is more prevalent because of the reason that there is the absence of the reason which causes the market efficiency to be realized very soon. Can anyone recall the three factors I mentioned in the Can anyone recall the uh, three factors I mentioned in previous class which necessarily invites the market efficiency? I mentioned three factors, three necessary contexts which are expected to have to achieve the market efficiency. Can anyone recall?
Neuroscience, psychology, and economics.
Sorry, I couldn't listen to you clearly.
Neuroscience, psychology, and economics.
That is the study of market participants' behavior. That neuroscience is the discipline which studies the behavior of the market participants by analyzing their neurochemical. Okay, but that was not the part of just the last class. Okay, can anyone recall that I mentioned that first reason that market can be efficient, that if the investors,
mistake and correlated mistake.
right, thanks, if investors do not do any mistake but random mistake, so positive mistake cancels negative mistakes out, negative mistakes cancel positive mistakes out, so which brings efficiency. The third factor, people do mistake but
Mistakes are correlated.
People do correlated mistake, and there is a presence of sophisticated investors who are known as arbitrageurs, who capitalize on the discrepancy and bring the market to the efficient. Okay, these are the necessary conditions to think of the market efficiency. Okay, just to give you the example from the local market, or from the local market. Okay, okay, you know very well regarding the arbitrage.
Yes, sir.
Okay, so I think you heard about it and the components or the necessary conditions for making arbitrage in the financial markets and institution course. Okay, so assuming that, I just like to recall you that the necessary conditions for making arbitrage. Okay. First of all, there should be the substitute. There should be substitute of the assets you are considering to make arbitrage. Okay, because you see, say GP and Robi, both are from the same industry, assuming that both have same fundamental, and also assuming that both should be traded at a very similar price. Say this like this. Just think of assuming this. Both companies are very similar. Okay. If for some reason, given that all fundamentals are same, no changes happened. If for any reason, we don't know what is the reason. Okay. And no one even knows that why it is happening. If for any reason, if GP price becomes 600, what should an arbitrator do?
So arbitrator should sell GP and buy Robi.
Okay, arbitrator should short the GP and long the Robi. In that case, when arbitrators, all arbitrators will start to do this, it is likely that their the price of both GP and Robi will return to the equilibrium level, and there will be no more arbitrage opportunity. Okay. Now, thing is that Robi has been listed in the market recently. Is there any substitute for GP? Is there any close substitute for GP?
No, sir.
In that case, there is no close substitute for GP. In that case, arbitrage will not work. It is not necessarily that I just have given example to understand it very simply. There may be another stock which may be from different industry, but it behaves like GP. It has been observed that it behaves or it trades at a very similar price to GP. It may be from another industry. For whatever the reason, we can think of that both stocks trade at a very similar price. Okay. So in that case, we should expect that if there is no close substitute, and then the arbitrage will continue. If arbitrage will not be able to happen, if arbitrage does not happen, in that case, what should you expect? You would expect that you would see that GP is trading at 600, GP is trading at 650 for 2 years, for 3 years, for no reason. Or GP is trading at, say, a very low price, say 200 or 245 for long years, 2 or 3 years, for no reason. Okay. Why? The arbitrators are not playing because arbitrator, no close substitute is available to arbitrator to make the profit from this discrepancy. Okay. Okay. That is very fundamental example, but that is not very crucial to understand here. But you need to keep those in your mind. Another one, transaction cost, no transaction cost. Say there is a price discrepancy in the gold price between the gold trading at Middle East market and the Asian market. So you like to import gold from Middle East and to sell in the Asian market, but government has imposed tax in such a way that after considering transaction cost, there has been no difference between the price of gold in Asian market and also in the South Asian market and the price available in the Middle East market. Would your arbitrage will work?
No, sir.
In that case, your arbitrage will not work. In that case, you would see that in South Asian market, gold is trading continuously at a higher price, and in the Middle East market, the gold is trading at a low price. Okay. Otherwise, arbitrage would make the price of gold between these two markets same. Okay. So that is easy to understand. Now, arbitrage principles assume that they will not make their own money. They will use other people money, or they will make no investment. They will make no investment. They will make no investment means they will not, arbitrageurs will not use their own capital. Arbitrageurs use the money from other people. That is a very common issue, that arbitrageurs, the financial market participants who do the arbitrage, they use other people money to play in the form of arbitrage. Okay. But you see, when you are using other people money, okay, say think of hedge fund. One of the strategies hedge fund uses to make outperformance is making arbitrage when they have been able to find out a profitable arbitrage. Obviously, if there is no profit, there is no arbitrage. Arbitrage is always profitable. Okay. So when they try to look for arbitrage opportunity. Okay. The thing is that, let's say we have right now 54 participants. Okay. So I have created a hedge fund. Say we have given the hedge fund name the 23 hedge fund. Okay, it is not 23 hedge funds, 23 is the title. Okay. So I have taken money from all of you, and I have found the discrepancy in the market and invested there. Say that I have invested in Tesla, that Tesla is trading at a higher price, and Tesla should trade at a very similar price to, say, Ferrari. Assuming that both are closely substitute, and I am taking long position is in Ferrari, and I am taking short position in Tesla. So what is my expectation? If Tesla price is very, we expect that Tesla and Ferrari should trade at a very similar price. And now Tesla is trading at a very high price, and Ferrari is trading at a very low price, say. So I have taken short position in Tesla, and I have taken a long position in Ferrari by using your money. Okay. And just think of if it happens, but I have invested the money by taking money from you. So my expectation is that over the time, Tesla price will come down, Ferrari price will go up within very 1 year. But say it has been already 3 years, Tesla is continue to go up. There has been no change in Ferrari, because all investors are have made crowd in the Tesla investment. No investment, no investor is no longer interested to make Ferrari, to make investment in Ferrari. What would you do? 54 participants, what would you do? How many of you would like to expect that I refund your investment immediately? Raise your hand out of 54. It has been already 3 years. How many of you want that I will refund your investment and I should not continue making investment anymore? Only one. Then have we got the point? What is about we are discussing?
Yes, sir.
Okay. Only 2 participants will want their money back from me. What about other 52 participants? They want to continue their investment with me?
Yes, sir.
5, 6, okay, 7, 8. Okay, the observation is that the number of participants who want their investment back, they can't wait. They can't wait anymore, is going up. Okay, that is the very natural. That is very natural that people are in general impatient. People are in general impatient. In that case, when you want your investment back, what I need to do in this given situation when the Tesla price is very high and there has been no change in the price of Ferrari, if I have to close the short position, I will invite enormous loss. I will invite enormous loss in my account. I will invite enormous loss in my account if I close the short position immediately, as
Yes, sir.
my investors want their money back. They can't wait they can't wait anymore. In that case, I am expecting to face the enormous loss in my account. If it is likely, arbitrager will be very likely to make profit from discrepancy, or they will feel it is very risky to engage in this kind of arbitrage. What do you think? It is very likely that arbitrager will continue this kind of situation, or arbitrager will feel very warm that they will make money out of these opportunities. It is very unlikely when they see that there is a good chance of making enormous loss. And can anyone tell me what is the reason why people are making overestimation on the potential of Tesla price? There may be several reasons. There may be several reasons. One common reason is that their subjective belief expressed by their sentiment on Tesla stock. There is a high sentiment for Tesla stock. Their subjective belief that Tesla will outperform is very high compared to the probability justified by the objective estimate. That's why you see there is a good discrepancy between the price estimated by the analyst. Okay, so who trade based on the sentiment, or who take position based on the sentiment, or who take position based on the overconfidence, or who take position based on the behavioral bias, or who take position say I am very optimistic regarding the Tesla. In that case, I just have bought Tesla without considering any other issues or objective probability. In that case, the people who make trade based on some noises, based on some biases, or because I have bias, I am biased to some information, and I'm overconfident with some stocks. In that case, I will be known as noise trader. The people who make trading based on the noise, not based on the information. You know the difference between noise and information?
Yes, sir.
Okay, so it is very likely that people across the market try to make investment based on the noise. In that case, these people are likely to face significant loss, and they are the people who are responsible for making market inefficient or far from the inefficiency. Okay, say just think of for last 2 years, GP was trading at a very low price compared to its fundamentals. Okay, just because of the noise trading, because of the people are not enough confident regarding the GP prospect. Either right now they are overconfident, or 1 year back they were very underconfident. Okay, so the thing what I like to mention that behavioral finance identified that there is a limit to arbitrage. There is a limit to arbitrage. In traditional market where efficiency of market is expected, there is no limit to arbitrage. But in behavioral finance, it has recognized that there is a limit to arbitrage. So what do we mean by the limit to arbitrage? Because it is not likely that arbitrage will always play. Arbitrage will always come into play. There are some limitations. Okay, we already have recognized that. So in that case, if there is a limit to arbitrage, you should not necessarily expect that efficiency will happen and there is no presence of obviously there will be presence of anomalies in the market. Okay, so you need to recognize that, and there has been a good amount of evidence that how limit to arbitrage discourage the arbitrageurs to make opportunistic gain from the arbitrage. Okay, though there is a presence of arbitrage. Okay, so that's why the discrepancy in the price continues to hold for long years. And you see for the January, what we have observed, the January effect, that the return will be higher for in January month. It has been observed for many years. It has been observed for many years. So just think of, if there is an arbitrage, there are the presence of good number of arbitrageurs. Should it continue? It should not continue, because when arbitrageurs will crowd in the market, that will wipe out this kind of abnormal return. Okay, so we learned about the mean variance portfolio construction from the very early days, and you already have learned it. I just like to give a high level review that you already have learned, what you have already done, and you are expecting to submit your term paper on that. That is the efficient portfolio construction using the Markowitz portfolio principles, and the portfolio is known as mean variance portfolio. Okay, so what you have done in the first stage, you have submitted assignment based on the IPS. This is the systematic beginning of the traditional perspective on portfolio construction. You need to be very clear that you have a IPS which guides you for what? It guides you for investment objective. It gives you the consideration of risk for investment, and it enables you to know about the investment constraints, and it also give you the learning of the circumstances you are expecting to face. And based on that, you start selecting securities, picking the securities based on some principles, based on some criteria. It may be you are sorting based on the price earnings, you are sorting based on the price to book value, or you are estimating based on the price to sales. Whatever, you have some shortcut of selecting securities, and based on that, what you are doing, you make use of Excel, or you make your calculation manual, that 3 asset portfolio, 2 asset portfolio. You like to construct a portfolio which is mean variance efficient, which is kind of, you want to get this envelope curve which is efficient frontier. that you want to make investment only on the portfolios, only on the assets which are efficient. You consider only the expected return and expected risk in constructing your portfolio, and you don't make investment here. You don't make investment here after getting your efficient portfolio envelope curve. You from your beginning lecture of this part, you have heard that out of this efficient frontier, you like to uh, get the point where your utility curve intersects with the efficient frontier. If intersects in this part of efficient frontier, you make investment here. Or if it is like that, your utility curve is like this, it touches here, in that case you make investment here. So that is the way how you make investment traditionally. But matter is that when you make this kind of portfolio construction, you implicitly assume that all types of information or all necessary information are available with you. You have no shortage of information, and you assume that when you will construct your efficient portfolio, also you also assume that uh, you are, or your investors are RAM. Can you recall the RAM? Can anyone recall the RAM? I mentioned about the RAM in previous lecture, that what do we
Rational economic man.
right, thanks. So we assume that all or when you yourself as an asset manager will construct the efficient portfolio, we assume that we are rational economic men, or your client is a rational economic man. Okay, two people have raised your hand. Would you ask your question?
স্যার আমার একটা কোয়েশ্চেন ছিল, যদিও কিছুটা অফ রিলেটেড, লাইক টেসলা নিয়ে আপনি কথা বলতেছিলেন, সো
Okay,
টেসলার প্রাইস
in that case, can I take your question after stopping our class?
ইয়া শিওর।
Okay, 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 okay. Now the thing is that we do not uh, we do not consider the limitations that there is a shortage of information. Okay, just to give you an example, you want to make efficient portfolio construction by using your Excel, what you have learned from previous class, by choosing 20 stocks. Okay, or by choosing 15 stocks, whatever. Can anyone tell me, anyone including Rovi? Is there anyone who is going to include Rovi in your 20 stocks?
Yes, sir.
Okay, so you are planning to include Rovi. Okay, now tell me, you need to collect the price of Rovi for last 2 years or 3 years to get the expected return and to get the expected risk.
Yes, sir.
How you'll get this?
Sir, peer company select করে।
So is it a reliable approach? Rovi
No,
is
sir.
trading at a very Rovi was making loss for several for a long years. If you pick the peer stock, it is very likely that you will pick the GP. But do you think that GP will approximate the expected return and volatility for Rovi, given that there is a good differences in their fundamentals, financial fundamentals?
স্যার কিছু তো এলিমেন্ট অফ এরর থাকবেই।
Okay, just I'm asking that whether it will be a very good, reliable proxy.
No, sir.
Okay, so that's why you have a disadvantage in terms of information availability. But you love to include Rovi in your portfolio. But because of the information unavailability, will be very unlikely to accommodate the Robi based on the information availability. Okay,
স্যার
because
একটা ভালো ইনফরমেশন স্যার আমার কাছে আছে স্যার, রবির কাস্টমার বেস এবং জিপির কাস্টমার বেস স্যার এই নাম্বারটা অ্যাভেলেবেল, ওয়াইডলি অ্যাভেলেবেল, এবং আমরা জানি যে এভারেজে কত কাস্টমার স্পেন্ড করে প্রতি মান্থে অথবা প্রতি 6 মান্থে। স্যার এই মেট্রিকে দুজনকে হয়তো ভ্যালুয়েশন করা যায়।
Okay. Now we estimate our expected return based on what?
So past price.
Past price. Okay. When you make average for getting the expected return, right? When you make the expected return for GP, what you will do? You will make a return calculation for every month, say. Then you will take an average of this, right?
Yes, sir.
Okay. But what you don't do, what you do not do, you do not assign probability for each of the return. You give the equal weight for each of the return. Do you expect that it is very equally likely for all return? Is it very likely that equally likely that all returns have a similar chance? In that case, your equal weighting of probability is justified.
So question টা cover করুন।
When you collect the return for each of the month and you get the expected return by doing some averaging, okay, you ignore the differences in probability for each of the return. Rather, we are very likely to make the simple average.
Simple average.
So in that case, do you expect that all of these returns are equally likely?
Yes sir, এই assumption ধরে
No,
নেওয়া হয়েছে।
sir.
So in that case, by doing this kind of strict assumption, or by doing this kind of naive assumption, what we are doing, are we following the rational portfolio construction expectation, or we are some kind of diluting those expectations?
So diluting those
That
expectations.
means we are not we can't comply with the probability principle. We can't comply with the base principle in reality because of some limitations, because of some constraints. Okay, that's why behavioral finance comes in to accommodate those limitations. Okay, so matter is that say you are wanting to make you want to make IPS for your client who does want to include a Robi in the portfolio, his portfolio, but your criteria of selecting stocks are such that based on some objective criteria are such that Robi is excluded, but your client wants to include Robi in his portfolio. But if you follow the why your client is wanting to include Robi, because he believes that as he is a subscriber of Robi, he wants to include Robi in his portfolio, or your client is an employee of Robi, that's why he has biasness for Robi. He feels that Robi will do good because he is employee of Robi. So, but your portfolio criteria does not give weight to Robi because it is not objective. The objective criteria is not satisfactory for Robi. In that case, if you tell your client that I do not, you should not include Robi, but your client wants to include Robi, there will be conflict.
Yes sir.
Okay, so why your client wants to include Robi? Because he has some behavioral bias. So your efficient portfolio construction has not provided any room for behavioral bias, has not provided any space to accommodate the behavioral preferences or behavioral biases of individual client. Have you got the limitation of efficient portfolio construction or the Markowitz portfolio principles or mean variance portfolio principles? You have no space for incorporating your emotional attachment or your behavioral preferences, these things. Okay, so these things have been addressed by the behavioral portfolio construction, and behavioral portfolio theorists have provided some theories up to today that but you see that in traditional finance a very limited number of theories are available, but as behavioral finance is evolving, the problem is that behavioral finance has provided a number of theories to explain the market behavior and to accommodate the portfolio construction. But the problem lies with also behavioral finance because there is no single theory. There is no single theory in the behavioral finance which helps you to explain the market behavior. Rather, there is an array of theories. Okay, say efficient market hypothesis, how market behaves, how market should behave. This is the building block of classical finance or traditional finance. Have you ever heard about anything that is competing with the efficient market hypothesis in the classical finance? Have you heard about any theory that is the alternative of efficient market hypothesis regarding the market behavior? Have you got my question? Say mean variance portfolio construction using the Markowitz portfolio theory. This theory is commonly adopted by the portfolio managers to construct their efficient portfolio. But has anyone heard about any theory which is alternative to modern portfolio theory or Markowitz portfolio theory in the classical finance? Have you got my question? Have you got my question? I'm getting no response from you.
Sir, behavioral portfolio management.
Okay, behavioral portfolio management is out of the classical finance. Okay,
Yes,
but I'm asking that in classical finance, in addition to efficient market hypothesis, has anyone heard any alternative explanation or alternative theory which explains the market behavior? The answer is no. The answer is no. You will explore that these are the common theories. If you take BBA, if you take MBA, you take MSc, or you take PhD in finance, you need to continue with the efficient market hypothesis. You need to continue with the Markowitz portfolio theory. You need to continue with the Fama-French three factors model, because these are the very common theories in the classical finance. But in behavioral finance, a number of theories have been evolving. But the problem with the behavioral finance is that there is no single theory. There is no well accepted, there is no widely accepted theory in the behavioral finance which is look like the classical finance. That's why though behavioral finance has evolved, but the acceptance for behavioral finance model is yet to be satisfactory because there is no single theory, a wide number of theories in behavioral finance. Okay, so we will try to discuss a selected number of theories which have been proposed in the behavioral finance. First one is regarding consumption and saving, regarding asset pricing, regarding how portfolio is to be constructed, and how market behaves, or the people who or the participants, how they survive or why they do not survive. The behavioral model, what is explaining regarding this condition. Okay, so first of all, in consumption and saving, can you recall we tried to solve some problem using utility function. Using utility function, we tried to determine what should be the optimal consumption in current period, what should be the optimal consumption in future period. Can you recall? Can you recall?
Yes, sir.
Okay. So what we assume that people want to maximize their utility. People want to maximize their happiness by taking consumption which is optimal for different period. Okay. This is the principle of Markowitz portfolio theory, which has been evidence or which has been supported by a number of economic theories, that people should make, or rational people should make decision in such a way. Okay, but the thing is that in uh, the classical finance also includes the principles that people should have self-control to maximize their long-term benefit. So what do we mean by the self-control here? Say, say you are very impatient and you have borrowed all of your based on all of your future future potential income. Can you recall your maximum borrowing level? This one, your maximum consumption level, this one in the current period, maximum consumption, this one plus this one, y1 1 plus can you recall this maximum consumption in current period? What can you afford?
Yes, sir.
Okay, but thing is that if people do not follow self-control, if people do not follow the self-control, people want to think of short-term benefit, people want to if people are more focused on short-term, people benefit in accrued for long term will become lower. In that case, their available wealth to ensure their long term well-being will go down if people are very short term focused. Okay, these are some kind of things what we learned from classical finance or the life cycle theory of making life cycle theory to understand the consumption and saving pattern in the classical economics also. But the thing is that people, it is likely that according to the classical finance, what I just have showed, that to ensure the optimal consumption, the utility theory tells you that if your, say, if your CO or C naught is greater than Y naught, C naught is your optimal consumption, what did you do? If your current optimal consumption is greater than current income, what would you do according to the classical finance?
I will borrow.
You will borrow. Can anyone tell me you have made borrowing, and you want to maximize your consumption, or you want to continue your consumption by making borrowing? You make borrowing only when you feel that you need to borrow. But has anyone done this kind of thing, that he consumes by making borrowing? Is it very likely that people make consumption by making borrowing?
It depends.
Obviously it depends, but I ask that it is very likely that, or it is very unlikely that people continue to make consumption by making borrowing?
Sir,
It's
unlikely.
unlikely, sir.
Hmm?
Unlikely, sir.
It is very unlikely that people will depend on the borrowing for making their consumption efficient. Okay, so that is in contrary to the conclusion of classical finance. Okay, so the thing is that behavioral finance, uh, in opposite, behavioral finance tells that it incorporates the self-control, mental accounting, and framing bias in life cycle theory. Okay, so let's just give a high-level comment on this. The thing is that uh, instead of the classical finance, behavioral finance, assuming behavioral finance theory for consumption and saving includes people's tendency that they want to maximize their short-term gratification, short-term satisfaction. In addition to that, they also want to satisfy their long-term expectation or long-term goals. So people make a trade-off that it is not always the obvious that people always thinks on their long-term well-being. People also try to make some short-term satisfaction, which obviously dilute your available wealth for long term. But behavioral finance includes this kind of people's tendency. Second one, uh, have you ever seen that our mother at home keeps their keeps their income in a way that they think in a way that I have put 10,000 for house rent, I have put 5,000 for food consumption, I have put 2,000 for our uh, house worker, and I have put 3,000 for shopping separate, and I will put 1,000 for saving. Have you seen this kind of bucket at your home
Yes, sir.
that people do?
Yes, sir.
Okay. But don't you think that money is fungible? Money is fungible means that money is transferable between this bucket.
Sir, they do not like transferring.
They do not like transferring, but the thing is that money is fungible.
Yes, sir.
And when you make expenses, it is unlikely that you can uh, clearly identify that this income is coming from my salary, or this income is coming from my this expense I'm bearing from my wealth, or this expense I'm bearing from selling my bond. Is it very easily traceable when you spend money?
No, sir.
So that's the concept of money is fungible. Okay, and another concept money is fungible is that people can make intertemporal borrowing, that you have say you have 1,000 income in current year, but what can you do? You can increase this by borrowing against your future income.
Yes, sir.
So people can do this. So money is fungible, money is intertransferable between the intertemporally transferable. Okay, so people disregard this kind of fungibility, people disregard this intertemporal transferability of money. Rather, people want to use the mental accounting to make their expenditure and to make allocation of their wealth. And people also have a framing bias. The thing is that when people, same question is asked to people in different way, people respond differently. In previous class, I showed you evidence that when the same question is modified, your response changes. So that is the problem of identified by the framing bias. So Sheffrin and Thaler identified that, or found that, and also suggested that people classify their sources of wealth into three basic accounts. One is their current income, Another one is their current wealth. Another one is the wealth which is available against their future income. Against their future income, because people can make borrowing against their future income. Or you probably can recall this. This is known as present value of future income. Sorry, this one is present value of future income. So Sheffrin has classified people wealth in these three ways. Okay. Now, tell me, do you have any immediate expense? Which one you will pick first? This one, or this one?
Current income.
Current income, then?
So current wealth.
Current wealth, then?
Then sir, present value of future income.
Okay, but what classical finance assumes? Classical finance assumes that when you see there is a shortage of making optimal consumption in current day compared to your current income, what you would immediately do? Immediately you will borrow against your future income.
Yes,
But
sir.
that is not done by people really. Okay, and we see that classical finance also assumes that people make savings after having their optimal consumption, or after having their optimal consumption, they make what? They make disposal income available. After reducing this, after considering consumption, they make savings. Okay. Can poor people make savings? It is very likely that poor people make savings.
No, sir.
So it has been identified, or it has been mentioned by Sheffrin and Thaler that savings for poor people is a luxury. Savings for poor people is a luxury. Okay. So though optimal consumption, after making optimal consumption allocation, people would make savings, but from the perspective of poor people, savings is very unlikely. Okay, now
স্যার একটা কমেন্ট ছিল।
right, okay,
স্যার আমরা যে কারেন্ট ইনকামের পর কারেন্ট ওয়েলথ ইউজ করি এবং তারপর ফিউচার ইনকামের প্রেজেন্ট ভ্যালু ইউজ করি, স্যার এই সিকোয়েন্সটা স্যার ব্রেক হয় নরমালি একটা ক্ষেত্রে যখন আমরা ক্রেডিট কার্ড ইউজ করি স্যার।
you're right.
Yes,
Okay,
sir.
but if you look at the most of the people's behavior, what they do?
Sir, most of the people follow
This
behavior.
Most of the people follow this
Behavioral sequence. Yes, sir.
right. Okay, so that is explained by it. Okay, now the thing is that if I ask you the marginal propensity to consume, you know it very well from your microeconomics and also from the beginning lecture of this course. Okay, between the current income and the income to be available by borrowing from the future income, in which case your marginal propensity to consume will be higher, here or here?
CY. CY.
Current income, right?
Yes, sir. Yes, sir.
Okay, now say you just have received a bonus from in addition to your salary. Okay, so there are two people, one people is A, another people is B. Person A has classified his person A has classified his bonus as his current income, and person B considers his bonus as part of his current wealth, because person B immediately after receiving the bonus has deposited his bonus to his savings account. Now tell me, between person A and person B, which person is very likely to spend his bonus earlier?
Sir, A.
Because
Sir, current income is include করে নিয়েছে মানে mentally.
Because people has person A has included his bonus into his current income. So when people make expenditure, people consider the wealth what I will use for making this expenditure, from which part of my wealth it is coming. If it is coming from current income, I am very likely to spend it. But if it is very likely that it will come from my borrowing from future income, people try to be conservative to spend their money. Okay, so this is the way how behavioral finance explains our consumption and savings behavior. Okay, the second one, what we like to address, that is the asset pricing part. Okay, how behavioral finance includes it. I just have given example that for higher sentiment, the GP price, for example, has become very high, or Tesla price has become very high. Okay, but when you will make classical finance asset pricing model, if I ask you regarding the asset pricing, which thing comes first in your mind in your finance? In your finance learning, if I ask you to talk about the asset pricing, which one comes first in your mind?
So capital asset pricing model.
Capital asset pricing model comes first in your mind, right? Okay. So I already have showed to you that based on the CAPM, we estimate, based on the discount factor available by CAPM, we estimate at what price a stock should trade. But most often we see that a stock, for example, is trading at a very higher price, which is justified by our CAPM, which is justified by our CAPM. Or alternatively, we are very likely to see the price which is justified by the CAPM. The price is the market price is very low compared to the price justified by the CAPM. Okay, so the thing is that I just like to add this concept to your mind, then I will explain what we are suggesting in terms of behavioral finance. In classical finance, how we form the discount factor? We add the risk-free rate with some fundamental premium, right? Systematic, which explains the systematic risk.
Yes, sir.
Okay, this is our composition of discount rate. Okay, but based on that, we see that the price justified by the CAPM is higher than the price at which the stock is currently trading. So stochastic discount factor is the discount factor which we typically use for discounting any future cash flows. But the term is stochastic. Instead of simply discount factor, it means that the discount factor should accommodate the probabilities of the cash flows which will happen in future. You see, when we discount any cash flow, we keep our discount factor constant in denominator. Can you recall?
Yes, sir.
We keep our discount factor constant.
Yes, sir.
But do you think the probability for this cash flow and probability of this cash flow, probability of this cash flows are same?
No, sir.
These are different. And based on the nature of the asset of which payoff you will enjoy will also differ in terms of their performance. Just try to give another example, that the economy is doing very poorly. Economy is doing very poorly. You have two assets. One is your stock Another one is, for example, your insurance asset, insurance policy. Is insurance policy as an asset for you?
Yes, sir.
Okay. Now tell me, between a stock and between insurance policy, which one is your friend when the economy is underperforming?
Insurance policy.
Insurance policy. So between a similar stock and insurance policy, similar means their payoff are similar, but stock payoff will be available when you are happy man, and insurance policy payoff will be available when you are unhappy man. Which one is your best friend, insurance policy or a stock?
Insurance policy.
Insurance policy, because it helps you when you are not getting help from others, but a stock is helping you when others are helping you. In that case, which price should be higher, the stock price or insurance policy? I mean, which will be given higher weight by you?
Insurance policy.
Insurance policy price will be given higher value to you. In that case, you will put less discount rate for insurance policy, you will put more discount rate for a stock.
Yes, sir.
Have you got it? So that is the essence of a stochastic discount factor, that you consider the associated probabilities and associated uncertainties in the discount factor. It may vary based on the uncertainties, contingencies, these things. Okay. Now the thing is that behavioral finance tells that in addition to the composition of discount, in addition to the existing composition of discount factor, what you do for estimating the price of asset, you include a sentiment factor premium. You include a sentiment factor premium. Say the GP is trading at a low price, probably for a reason that the sentiment for GP is very low. Instead of having good fundamentals in future, people have a subjective belief that the GP is not good for me or GP is not good investment. But people's subjective probability for underperformance of GP is higher than the objective probability of underperformance of GP. In that case, the GP price is lower. For what reason? Because people have a low sentiment for GP stock, right?
Yes, sir.
Okay. So in that case, to justify that price, you need to raise your discount rate.
Yes,
To
sir. By
justify
adding.
this low price, you need to raise your discount rate.
Yes, sir.
Behavioral finance tells you that you need to raise your discount rate by how much?
The
By the
sentiment premium.
sentiment premium. Okay.
Is there
So
any way to quantify the sentiment premium?
yeah, that is a big
Or
question, and that is
average
an
value?
interesting question. And Sheffrin has mentioned that we can approximate the sentiment premium, or we can approximate the sentiment first by looking at the discrepancy in the analyst expectation of price of a particular stock. Say I shared an example with you that Tesla has been estimated by 70 and 650 by two analysts, JP Morgan and another one, Morgan and Stanley, probably, I can't recall right now. Okay, two well-known analysts make very large discrepancy between this between the same stock price worth. Okay, so Sheffrin has suggested that you can look at the discrepancy in the analyst price expectation to understand the sentiment. Okay, to understand the sentiment risk premium. Okay, and there are some indexes, closed-end fund discount, and Baker and Ugler sentiment factor, and also known as Google search index. Google search index. Just think of if people are very excited for GP, if people feel very excited for GP, what people will do?
They will search more about GP.
They'll search more about GP. Okay, but opposite may happen also.
Yes, sir.
Opposite may happen also.
Yes, sir.
That is the challenge of using the search index as a sentiment index. Okay, but you will be very happy to read this kind of papers who use several matrices to measure the sentiment. Okay, so there is also several other indexes. What I'm not mentioning right now because of time constraint. Let's continue. Okay. So what behavioral finance is telling you regarding the portfolio construction, you already have learned what Markowitz has told you, that we talked about. We take this, we always assume the investors are risk averse, and we construct a portfolio which should comply with the mean variance efficiency, and we need to look covariance very carefully because it affects and the diversification objective you are expecting to achieve. So it is very important in Markowitz portfolio theory, which is a very good contribution in addition to the simple risk and return or expected return and standard deviation approximation, which is available from the statistical analysis. Okay, but covariance inclusion is very good contribution in Markowitz portfolio theory, that we need to include the correlation between assets to achieve the expected objective. And instead of looking at the expected risk and return of individual asset in Markowitz portfolio investors are very interested in with respect to the expected return and expected risk of the overall portfolio, not the individual one. Expected portfolio return and expected portfolio risk. Okay, you know it very well. Just think of what behavioral portfolio theory calls for. Behavioral portfolio theory calls for, instead of thinking of real portfolio, people use the probability weighting function. Okay, can you recall in prospect theory discussion we made some graphing where we showed you that when there is an uncertainty, there is a low probability estimation, people when there is a higher objective probability, people want to make higher estimation of probability, and when there is a high probability in objective basis, people want to underestimate that probability. This is the subjective probability line. Okay, and this is the objective probability line. Okay, so this probability weighting function, there is some modification and there is a way how you can measure this. This has been called by the behavioral portfolio theory. Instead of real probability distribution, people use this probability weighting function to get the expected outcome of their different prospect. Okay, and what is the marginal learning from behavioral portfolio construction? That is this thing which is very important, that instead of constructing instead of thinking of portfolio as a whole, people construct portfolio in different layers. People construct portfolio in different layers. In a portfolio, people think of different layers. So one layer, people would say that is very risk free, and another layer would say that moderate risk, and another layer is for speculative risk or very high risk. Okay, so I will explain more about it in a next slide, but the thing is that there is a differences between each of the layer in terms of the expected return and in terms of the people's attitude toward risk. So you already have recognized when people attitude are very kind of risk averse, very risk free, people will invest more in risk free. if people attitude is very high risky, or people attitude is very risk taking tendency, people will have more investment in high risk or speculative part of their layer. Okay, and it has been identified by behavioral finance portfolio construction that diversification may be one of the objective, but diversification is not necessarily an objective of portfolio construction. There is a very major difference between the modern portfolio theory or MPT and the BPT. Okay, so uh, there are some additional discussion what you need to accommodate in behavioral portfolio construction. So I just like to give a summary of this. Like, think of uh, people have several goals. So for layer one, people may have separate goal, and for layer three in the portfolio, people will have separate goal. Okay, but if the thing is that uh, in layer three, people want to make investment for having very high gain or kind of very upside gain, and people want to make investment in layer one not for very having very high gain or high potential gain, rather people want to include this layer one just for reducing the probability of having the downside losses. So it is a kind of insurance protection or kind of safety. Okay, so if a person between say if a person A feels that it is more important to me, where I have upside potential, and I like to put more importance on it. In that case, which layer will receive more fund from this investor? Layer 3. Investor is thinking my consideration of upside potential goal is more important to me compared to my layer which I have maintained for protecting my downside loss. In that case, which layer will receive more funding?
Yes, sir, layer 3.
Layer 3. And in opposite case,
So
layer 1 would receive more funding. Okay. And if the thing is that people has set a very goal which is very big goal, say people want to say kind of Elon Musk goal is very high and is a kind of a speculative in nature. So say Elon Musk is wanting to buy a personal jet. Okay, so if Elon Musk wants to have a personal jet very shortest time, very shortest possible time, in that case, which layer he should make more investment in, layer 1 or layer 3?
layer 3.
Layer 3. Okay, so sometimes people you would see which has been identified by behavioral portfolio construction, people you would see that, for example, in my case, that I have been continuing my losing position in GP for last 3 years. Can anyone tell me what is the reason why I'm continuing with it? Because I have plenty of information about GP what people do not know. Is this the case, or I do not love to or I do not love to realize the loss?
No, sir, you expect the loss will be reversed or offset in the future.
Okay, I expect that, but I have given you two options. One is I have a superior information for GP, or I expect that I will feel sad if I realize this plenty of loss.
Yes, sir, the second one.
Second one between these two.
Yes, sir.
So investors exhibit this kind of behavior, that investors want to keep their losing position for a longer time. So people want to people have a loss aversion behavior. Okay, and if people has a such kind of behavior, okay, just tell me why it has been possible for me to continue the losing position in GP for 3 years, because I have been able to manage my expenses from my alternative income, alternative cash balances. Otherwise, would it be possible for me?
No, sir.
It would not be possible for me. So in that case, this kind of people, what they do, they hold higher amount of cash.
Yes, sir.
Which people?
যারা স্যার লস রিয়ালাইজ করতে চায় না।
Right. Okay, otherwise it would not be possible. So there is a very simple example for behavioral portfolio construction, and you will try to solve by yourself. Otherwise we will discuss in next class. But before that, I like to end today's class by giving you the highlight for the last theory for our today's class, that is adaptive market hypothesis. I'll be taking 5 to 6 minutes extra to give you the summary of this adaptive market hypothesis. Okay. Okay. The theory is related to whether you will be able to survive in the market or you will go out of the market. How behavioral finance looks at this kind of thing, that why say Lehman Brothers, which was well known and the leader in the financial market, had to close down their business, and what's the explanation from behavioral finance? Okay, the thing is that have you heard about Panda? Have you seen some movies where the panda is the leading actor?
Yes, sir.
Yes, sir.
Okay. Can anyone tell me what is the favorite food for panda? I mean, which food they
Bamboo.
Bamboo.
Yes, sir.
Okay.
Bamboo, sir.
Okay. Okay. If bamboo is not available, say bamboo has been cut down grossly, and panda is not habituated to take another food, like they can't eat wood or they can't take other food, what will happen to panda?
They go extinct.
They will go extinct. So the thing is that always there will be competition and there will be a scarcity of resources, and it is prevalent in each and every market. But if you fail to adapt that, you will go extinct. If you can't adapt easily with that, you will go extinct. Okay. So related to that example, what I like to highlight, that is the long-term capital management. It was a kind of hedge fund. It was a kind of hedge fund. It was established in 1994. Is it before your birth year?
Yes, sir.
Okay, it is before your birth year. Have you heard about this people name? Okay. Black-Scholes Merton. BSM, I probably have mentioned BSM in one of our previous classes. BSM, Black-Scholes Merton. For what? Option pricing model. Okay. So Merton Scholes, Robert Merton are not the practitioners. They are both practitioners and also the academician. Okay. So they provided the BSM model, which is based on the law of one price. Probably you have heard about it, right? Law of one price. Based on which arbitrage principle works. So they provided this model based on which you can identify that whether your option is overvalued or undervalued. whether you can have a arbitrage opportunity here or not. So that was very attractive that, and they were very successful that they have been able to make people convinced to invest this $1.01 billion with them in a very few months. So after having this investment, using their model, what they did, they used plenty of leverage to capitalize a small amount of discrepancy. Say they have estimated the Amazon, there was no Amazon there. They estimated the price of a certain stock, say 130, but it is trading at, say, for example, 133. Though it seems to you the difference is very narrow, but when you invest heavily, it will give you an enormous return.
Yes, sir.
So they capitalized huge amount of leverage for making gain from this kind of discrepancy and for making this kind of arbitrage gain. And they also employed some basically that strategy they have developed for exploiting the opportunity which is coming from what? Market anomalies. Which is coming from market anomalies. But the thing happened that when LTCM began applying their model, other arbitrageurs also employed themselves to get opportunistic profit in the same market. In that case, your expected profit will come down or go up?
Come down.
Your expected opportunity for profit will come down. In addition to that, they also make investment in Russian government security which are denominated in ruble. So Russian government in that time, 1997, when there was Asian financial crisis, so instead of making default in the Russian government securities, what they did, remember LTCM has made investment in Russian government securities by making short position, but LTCM did, Russian government make some regulation which causes that they will not make default. So you know very well that when there is a due date, if the creditor does not, if the borrower does not make payment on due date, there will be default. But by changing the regulation or by taking permission from the court, Russian government, what they did, they increased their due time of making payment so that they will not face default. Who? Russian government. So in that case, LTCM, who has taken huge leverage and who has taken good amount of investment from others, what investors would wait for realizing the gain for several years from LTCM. So LTCM could not close out their position because of sudden changes in the regulation in the Russia, and there has been wide panic in the Asian financial market, and there was also presence of the arbitrageurs who are following the same strategy as LTCM was following. So finally, what happened? The market collapsed, which was undesirable. And LTCM didn't change their strategy. Rather, they are using huge amount of leverage, and they are not prepared that what they would do if this kind of changes in regulation happens, and what they would respond to the investors' rush to withdraw their money if this kind of contingency happens. In that case, LTCM ultimately defaulted, and LTCM had to LTCM had to close their business in a very short time. Though US government provided some support for LTCM, some bailout support, but finally it couldn't continue their business. Okay, so it actually happened because of the presence of noise traders and because of the absence of the adaptability in the LTCM strategies and using the leverage. And there was also you can relate it with the limits to arbitrage, that the history of LTCM discourage the arbitrageurs to make position because of this kind of enormous loss faced by LTCM. LTCM was a US based hedge fund. So hedge fund is a very profitable, is a very attractive. In addition, you need to recognize it is very highly risky, high risk investment. So LTCM, you know very well, hedge fund make a very lockup period for 3 years, 5 years. Are you familiar with this? Hedge fund gives this kind of lockup period that you can't withdraw your investment within this time. Are you familiar with this?
No,
The
sir.
reason is that we may face some market abnormality, and it may very likely that this abnormality will continue for long term. So if investors don't wait for this 3 years or 5 years, and if we have to close our position, we have to incur a significant amount of loss. Okay, so you would you will be learn more about it if you have this text, The Inefficient Market by Andreas Schleifer. And Andreas Schleifer is one of the significant contributors in behavioral finance literatures. You will find his name common. He is a very well-known person to give explanation for limits to arbitrage, and also explanation for how investor sentiment brings the market abnormality, these things. Okay, so noting these things, I like to close our today's class.